Hey everyone, it's Pete Carmesino here at Chaikin Analytics. This is the halftime show on Stock Charts TV. And we're going to go over a few things today, like we normally do. We're just going to look at the overview of the markets, what's going on, what are some of the headlines are saying. And this is a big week. We've got CPI on tap. That'll be coming out this week. And in between all of that, or should I say before and during and after, you're going to get a lot of Fed speak, which some people like, most people pay attention to, others wonder why it even happens at all. That I think I'm in that last camp, but at the same time, it kind of gives you a view, behind the curtain look at what some of the members of the Federal Reserve Committee are either thinking about or talking about. Now, some are voters, some are non-voters. I mean, look, there's a lot of opinions there as well. At the end of the day, it's basically going to be data driven. They can say whatever they want to say. It doesn't matter. We talked about that many times. It's kind of what they say they're going to do that matters, but at the same time, it's really what they do that really matters. Right? If they don't do anything, the markets will adjust immediately and then take it on from there. So we're seeing trends. And speaking of adjustments, we've got an interesting piece of news that came out late Friday from the NASDAQ. They're going to be rebalancing. It's a special rebalancing. And you probably already guessed why. If you don't know why, I mean, it's a cap weighted index. And what happens is as these stocks grow and grow and grow, they become a bigger part of the index. And so there's 7 stocks out there that people are calling the Magnificent Seven. I would have personally went with Sensational Seven, but that's just me. We'll call it the Magnificent Seven. That's fine. It's Microsoft, Nvidia, Tesla, Alphabet, which is Google, Meta, which used to be Facebook, Amazon. And obviously those 7 stocks make up an incredibly large amount of the NASDAQ 100. So the NASDAQ 100 has these stocks in it, plus obviously 93 other stocks. But those names we just mentioned make up about 50% or more, depending upon what day you're looking at them. They were probably around 55% last week, and today they're probably less. You guessed, because they're down and obviously getting priced lower because they're going to be rebalanced or quote unquote sold, right? So at the same time, I think a lot of people are viewing it as an opportunity. I don't think it isn't at any, I always say, look, it's not just because of price. Find some levels that make sense. And obviously, if you're so inclined to take that risk, if you're willing and able to take that risk, you can probably add to some of these and snap them up at some prices that you didn't see before this announcement. So anyway, it's again just a piece of news. I think it's kind of shaking up the market a little bit, but the NASDAQ 100 has finally turned positive today. All markets are positive right now, S&P including the Dow as well. So you've got the tech rally, that momentum. We've talked about this now for months, if not certainly the last several weeks, but the momentum is continuing and things are going to continue to go in that sort of direction until something upsets it. And so what could be that? Well, it might be earnings. We've got earnings coming out, and that's kind of happening right now. And we also have yields ticking higher. And so the 2-year yield, the U.S. Treasury 2-year yield, is at highs not seen since 2007. Okay. It's concerning. I think what's odd is there are 6 months T-bills out there that are yielding more than the 2-year. And so that short end of the curve is definitely getting activity, and certainly is certainly attractive to the risk-free crowd of maybe sitting this particular run out, maybe selling into the second half of the year and taking that 5.5% in some cases, depending upon which day you can pull that yield down. The idea here is, I'm just looking at my notes, is obviously we're going to see some sort of effect of this, right? These rates, and I don't know if we've seen it yet, but we're certainly seeing areas that are slowing down. So we're going to look at just some names. One of the things that's popping today, and rightfully so, if you think about it, go back to my original comment about this rebalancing of the NASDAQ, is the equal weighted NASDAQ 100. And that symbol, it's 3 Qs with an E on the end. So QQQE for equal. And that's up almost 2%, about 1.75, almost 1.75% today. And obviously so, right? Because other areas of that ETF are getting activity, and it's just running in a specific direction that kind of puts us in a spot of more equal footing, right? Less concentration in those 7 names. We know with concentration comes risk, and you're not trying to beat risk. You're not trying to, defeat it or eliminate it, because without risk, there's really no return. Obviously, they've delivered their part. The Magnificent Seven is magnificent because of the return they delivered this year, but that could slow slightly, but I don't see that happening. Now, rates rising are going to be a headwind for sure for anything that's sort of long duration. We talk about long duration. I'm not talking fixed income. I'm thinking of, future growth opportunity. And when you've got the risk-free rate rising the way it is, people take that into account, and those forward-looking earnings get a little bit more discounted. And so those particular stocks get sold, like small caps. There's been a PE expansion. It's been amazing, but you really haven't seen earnings expanding along with those P's. So you need earnings at some point to be the footing on all of this projection going forward, because no one knows the future. We can make projections based off what's going on in the past, but at the same time, we've got to, at some point, somebody's got to pay up for these names and deliver the earnings. And so small caps really going to be on the watch list of, are they able to deliver the earnings that their sort of valuations are already calling for? But if they don't and rates start to rise, you might see a little bit more volatility in that section of the market. So mega cap still looks pretty good. Small cap is still kind of doing well, but I would think more sideways than any other direction at this particular point. All right, so let's dive into the charts. We're going to look at some interesting names here. We're going to look at the equal weighted ETFs, and I ran a special screen, and you can actually see it on Twitter. On my handle on Twitter, it's at Pete Carmasino on Twitter. I'll show you that link today as well, but I'll go over the screen and look at some of the names that came out, and they're basically names that have good earnings estimates or an estimate trend that's bullish or better going forward, but they have to be oversold too. Let's look at the list and take a look and see what we see. All right, folks, back here, just wanted to show you the Twitter handle again. It's at Pete Carmasino. You can come and take a look at the screen that I added here. You can see how I did it and read that. And here's that NASDAQ news. You can just go to NASDAQ.com and look at their press release. It's on the NASDAQ 100 index special rebalance, and that's going to be effective before trading on, again, prior to market open on July 24th. So 2 weeks. You can look at the methodology here, but they're trying to avoid an over concentration by redistributing the weights. Okay, kind of what we talked about in the beginning. So just so you know where you can find that, again, at Pete Carmasino on Twitter. You can take a look at what we talked about there. And then let's look at rates here. So, all right, so I've got a chart here that's kind of 3 panels. If you can't see that, obviously. Down here is the 2-year yield, and here's the 10-year, and here is the TLT, which we've been talking about. Now, I built this target months ago, if not a year by now, and the concern was that we were going to at least get back to these levels not seen since 2008. Now, for that to happen, you have to see rates move to levels not seen prior to that particular area. Right now, here we're talking about 2-year. Here's the 2-year down here. I haven't seen these levels since about 2007, give or take a basis point here and there. But it looks like that's June, I believe, of 2007. It's hard to read that even for me. And you can see where the 10-year kind of lit up. And then obviously when rates started to fall, they started to fall because bond prices rallied, right? Remember that. Bond prices move rates. It's not the other way around. A lot of people think that rates have some certainly effect on prices, but it's really the other way around. You trade bonds by price, which then is you get an effective yield. And then when those prices move, the yield changes. And so with anticipation, bonds either rally or sell off, and that changes the yield. And the yield in the bond market doesn't sit around and wait for someone to pull the trigger or change the rates at the Fed funds. Overnight rate, they move. Okay, so I'm seeing just a breakdown here. This below the $100 level on TLT, to me, just signals lower levels to come. Certainly the previous low of around 90 and change. You see exactly what that low was, about 90, spot 19. Anything below that level certainly opens the door into the 80s. And I don't think 75 to 80s that unreasonable at this point. Again, just a projection by me, not making a prediction. I'm just saying that following the path, the momentum is negative. Here, obviously rates are pushing higher, and we're at over 4% yield on the 10-year, not seen in quite some time. Obviously, October we saw it, but prior to that, we hadn't seen it since 2008. So just keep that in mind, right? These things are kind of happening. They're happening very, very fast. So let's look at offensive part of the equation here. We look at these sectors. I call them offense. There's defensive sectors, but these are my offense. So that's XLK, XLY. That's discretionary. That's tech is up top here. Consumer discretionary here, and communications down here. So you got Meta, other names in that particular group. You've got Tesla and Amazon here. And obviously in technology, the Magnificent Seven are heavily weighted. Now, the XLK is not getting reweighted, right? So this is, intact and moving higher. The Qs are getting redistributed. That's what you got to pay attention to. So on offense, things have looked great and still do. And if I look at defense here on the other side, the top one here is healthcare. The second one here is consumer staples. And the third one down below here in the bottom panel is utilities. And obviously the trend is negative there. So still being sold, it looks like. In general, some of these are up, but really kind of just choppy and really putting in lower lows here, especially on the healthcare. It's kind of interesting. Utilities doing the same thing. And actually, consumer staples is really testing a previous low right now. And so I think if it gets any lower, and this, by the way, just so I remind everybody, these are ratio charts. Okay, they're not actual charts of the ETF. This is the sector compared to the S&P 500 ETF SPY. Okay, so I just like to look at those just to kind of remind everybody what we're seeing, and I wanted to go over that rather quickly. Last thing we'll look at is oil, and I laugh because it's just funny to me that we see this particular level. I'm just going to delete this RSI right now. I need that right now. We just see this level time and time again hold. We called it the White House buy zone, 67.72. A lot of other people are charting this too. It's not that unique, but the idea is the White House said they were going to replenish the strategic petroleum reserves at these levels. And lo and behold, guess what? It kind of bottoms out there. Shocker. So we're going to see buyers here. We're going to see people cut production. We're going to see prices move higher from these levels unless that changes. And to me, obviously that's inflationary, which then gives the Fed cover to raise rates and so on and so forth. And so when the dominoes start to fall, things move into place, just like we saw in 2022. I don't know if it's going to be a repeat of that, but it could just be a bigger headwind than we anticipate. You just got to be ready to make changes to your portfolio. Yes, it's bullish now. It's always, we always want to look for the all clear signal, but there's never really an all clear signal because things are constantly changing. Just be careful and, realign your risk as things change. All right, we're jumping on the Chaikin system here. We're looking at, I've just got a list of equal weighted ETFs. The first one up top here, which is doing nicely today. As I said, it's up about 1.75%. Is the QQQE. It's been on a nice run. I mean, it hasn't really, underperformed at all. It really started to perform January 10th or so, but it bottomed previous to January after a quick sell-off. But the real bottom is where everybody else bottomed back in October. But, I like to look at this as an opportunity where it gets oversold and then relative strength is changing. It definitely firmed here. It just didn't pick a direction, rolled over and then moved. So you can really say from 63 to roughly 78. It's a pretty good number for an equal weighted ETF. Again, that means everybody's rowing the same, right? No one specific name or 7 names was pushing this. If I just type in the QQQ here, and you can see a rather dramatic change, again, right around that same time, but just a much better return, obviously, when you look at that. And then obviously you've got all these other names. And just a reminder, they recently changed these symbols, but you can look at, consumer discretionary also popping here. You can look at, this is the industrial also making a nice move. I believe this is information tech. Again, a huge move. And so we're seeing really, really big moves. I like the idea that, the equal weight could be a better opportunity. Again, if you're not in these names, you're not exposed to technology or materials or industrials, an equal weight is a nice way to get in, then obviously migrate into something that, once something starts to break trend and really break out and you can really identify more of a proper trend, you can, add to the cap weighted funds instead. And so those are the other sector funds, or the XLKs we talked about just before. As I said, it's one of the offense sectors, as I like to call it. So, you see this area here, this started to perform from a relative strength standpoint back in February, just took off, but really right around the turn of the year, beginning of January, everything started to run. And even this one is up, not, as much as you might expect. And why? Because it's got a lot of those big 7 names in here too. So you could see, again, I say you could see this kind of pull back slightly just because of that rebalancing that's happening in the Qs. Okay, last thing on the list here is sort of the screen of the week that I called it today. I put it out on Twitter. I just thought, it's an interesting way to look at this. And, what I was trying to do was find names that are in the mid-cap area, names that are in strong industries. So every one of these is a strong industry name. And one that has, and stocks that have at least, on the expert side, at least bullish or better estimate trend. This one's very bullish. And what that sort of entails is that obviously when you're getting estimates that are increasing, or the estimate trend is bullish and has been bullish, and you see 4 quarters in a row where these names have beaten earnings, especially a name like Beacon Roofing Supply, which based and then started to break out here, especially with the relative strength and the money flow and everything really is turning in its favor. What a great opportunity here. So when you see these kind of opportunities, you gotta take the leap of faith on these. Obviously, run your own risk of where you want to put stop orders in. But if you've got a good handle on what's happening in these names from a fundamental view, because of the power gauge and the technicals align, you're putting the odds in your favor. That's the weight of the evidence approach. You're taking all the weight that the evidence is giving you and then putting it in your favor or not in your favor. If things are going the other way, you may need to sell. But these are some of the names. You've got Cemex in here. Again, a cement construction company. BRZE, a software company, really popping today. A lot of these names are moving. Here's a semiconductor name, Credo Technology. Again, these are mid-cap names. Some of them kind of migrate into between the mid and large small caps or small mid caps. Another software company here. And then names that are a little bit more popular, like GitLab and KB Homes, right? Another home builder here from a household durable standpoint, just been on a tear. I mean, so you start to see these names, up over roughly 4.5%. You see this little exclamation point here. Well, that means estimates have been increased and the trend is obviously bullish. So these are the names that we ran on that screen. So again, if you follow me on Twitter, you'll catch this once in a while on off days when you're not getting a video here on Stock Charts. All right, everybody, that's all we have for today. Thanks for tuning in. Again, I'm Pete Carmesino here at Chaikin Analytics, Chief Market Strategist. Again, follow me on Twitter at Pete Carmesino. Hey, thanks for tuning in to the halftime show here on Stock Charts TV. We'll see you real soon. Take care.